All right. Hi, everybody, and welcome to today's Money Matters Q&A, Tax Tips for Authors 2023. As in past years, we're joined by Robert Pesce, Treasurer of the Authors Guild Foundation and a partner at the accounting firm Marcum LLP. Our host, Erin Lowry, is the author of the 4-part Broke Millennial series of books and a twice-weekly Substack newsletter. As some of you probably know, Erin has hosted numerous Money Matters webinars with us, where we've discussed personal finance and career growth for writers. You can find past events in the series in the resource library on our website and on our YouTube. If you're not an Authors Guild member, please visit authorsguild.org to learn more. Members can get legal advice, contract reviews, and we provide a variety of services for the business side of writing. Thank you to everyone who submitted a question in advance. We received hundreds of questions, and Robert and Erin are prepared to address as many of them as possible. Feel free to use the Q&A box here as well. We also have options for captions or a live transcript available. Robert, thank you so much for being here today, and Erin, thank you for moderating. Over to you.
Thank you so much. Hi, everyone. Wonderful to be back with you. I do want to say before we get started is a quick reminder that we have a previous webinar with Robert about forming an entity. When should authors create an LLC or S Corp? And we recorded that back in 2021. I'm actually going to drop a link into the chat a little bit later with that. So if you have any questions about LLC, S Corp, please refer to that former webinar. Now we will talk about it a little bit today, but there's a lot of information we could dig into on that topic. And also, as a reminder, we do have a previous webinar from 2022 about taxes as well. So anything that we don't get into today, you might be able to find in that one. Now, before we get into all the questions and answers, I am going to let Robert just address a few commonly asked questions, and we will then dig into your many, many questions. And again, please feel free to keep submitting into the Q&A throughout the webinar, and I will keep an eye on that as well. Thanks so much.
All right. Well, hi, Erin. Thank you very much for the introduction. And hello, everybody out there. Thanks for letting me do this again for you all. Yeah, I'm going to run through just some of the basic things that most people want to know, whether you're an author or not. We all need to know these things to do our tax returns. So a couple of key facts and figures for your tax returns this year. We still get something called the standard deduction. If you're married, that's $25,900. If you're single, that's $12,950. So that's, if you're not itemizing your deductions, you have the standard deduction, which is usually beneficial especially if you do not own a home. We're still allowed to deduct our medical expenses if they're in excess of 7.5% of your gross income. We can deduct state and local taxes if they're limited to $10,000 if you're married and $5,000 if you're single. And of course, mortgage interest is still tax deductible, subject to limits on the amount of your mortgage debt. The current mortgage debt limit is $750,000. So if you have a mortgage with a balance that's less than $750,000, you can deduct all the interest on it. We still have the popular child tax credit. It's $2,000 for each child under 17 years old. And the child care tax credit is a maximum of $2,100. That's if you both are working and supporting a child and paying for qualified child care expenses. So that's still popular and still available. If you're saving for retirement, we can deduct up to $6,000 for contributions to an individual retirement account. And for you all that are having self-employment income as writers, instead of doing an IRA, it might be more beneficial to do something called a SEP. And SEPs, the maximum amount that you can put into a SEP is $61,000. It's a great way to get a tax deduction and save money for the future. If you're saving for kids' college, the maximum contribution to a 529 plan for 2022 is $16,000 per person. And this year it's going to be $17,000. And the last item I wanted to talk about is just the self-employment tax, which is Social Security. The first $147,000 of self-employment income was subject to Social Security this year. That's my basic facts and figures for the beginning of the seminar.
All right. Well, digging into one question that's already been actually brought up in the Q&A, and it was asked quite a few times in the pre-submitted questions, is into the, are we a hobby or a business? So let's start by discussing how to determine if you qualify as a business for your 2022 tax return or moving forward in 2023. What are some of the current rules about whether it's a business or a hobby?
All right, well, I think in a word, it has to be, it's about intent. Do you intend to make a profit? Do you have the know-how to actually be a profitable writer? If you can't say yes to those two questions, you're pretty much doing this for a hobby. But it's okay to be a writer with intent to make a profit and not make a profit the first few years. My rule of thumb is if you're losing money 3 years in a row, you're going to be subject to some scrutiny, and you better be able to answer a few questions. Again, do you run the business in a business-like manner? Do you keep good records and books and records like a business would? Do you depend on this business for your livelihood? Is it really something that you really do to survive and thrive and feed your family? Some people think that establishing a legal entity creates demonstrates your intent. So maybe you do an LLC. I think that's a decent idea. I wouldn't say that you should do it just because you're afraid about being challenged as somebody who's not in a legitimate business. But it's really about intent. If your intent is to be profitable as a writer, and you believe that you have the talent or the know-how to be profitable, I think you go ahead and you report your income and your expenses, however much they may be, on your tax return as a professional author.
Well, speaking of keeping excellent records, do you have any software and or strategies that you recommend using to keep track of earnings and or expenses throughout the year?
Yeah. Software is great if you know how to use it, if you have the discipline to use it properly. But whether you do or don't, I would always tell my clients, and I work with lots of authors, I tell them to have a separate bank account for all your income and expenses for your work as a writer. And if you use credit cards to pay for things, you just pick a card. You have 3 cards in your wallet. Pick the green one or the gold one, whatever color you like. Make that the business card. So every time you use that card, it's for business expenses. So if you're out with your publisher or your editor or somebody that you're doing research with, and the bill comes and you want to pay for it, and you pull out the card that you decided is the business card, that's what you use. And this way, at the end of the year, the statement tells the whole story about your expenses. You don't have to cherry pick and figure out what is business or what is not business. And again, the bank account, the bank account tells the story about the ins and outs of your income. It makes it so much easier to figure out. And yes, if you're using software, even better. You just link it to your software and you get a nice clean profit and loss report for your accountant, and your accountant will love you instead of you giving them 12 months with the bank statements and credit card bills. So that's my basic rule of thumb to help you get away from the drudgery of spending the whole weekend getting ready for your accountant for your appointment.
Now, what about best practices for preparing to pay taxes on royalties or other writing income that a person receives, usually pre-tax? So taxes haven't been taken out, we get a lump sum. What do we need to think about?
Well, if you're lucky enough to get a nice advance, when that's coming, you call your accountant if you have one, and if you're not, just think about how much money you think you need to put aside for these taxes that are on this income. I tell people, as a rule of thumb, assuming you're going to have some expenses, as a rule of thumb, I would put at least a third of that income away for taxes. And I say at least because I live in New York City, and it's more like 50% here in the city. But I would definitely reserve at least a third for taxes. I would definitely talk to your accountant about it. And hopefully this is happening on a regular basis, and you're already paying taxes on a quarterly basis. So that you're paying taxes as you go. But it's very important to reserve the money and make sure that you're in touch with your accountant.
Well, I want to dig into quarterly taxes quickly because we did have a few questions come in about that. So can you expand for our viewers, what does it mean to pay quarterly estimated taxes and who needs to be paying them? Okay.
So a really simple example is you're a single person, you're an author, and it's your second year as a successful, profitable author. So you did your 2021 taxes, and you had, let's say, $10,000 in taxes on your tax return. So you talk to your accountant as you're finishing that tax return and make a plan for what you think you should be paying for 2022. So this happened last April. And your accountant asks you a question like, is your income going to be more in 22 than it was in 21? Or is it going to be the same? Or is it going to be less? And hopefully your answer is, it's going to be more. I'm getting my second tranche on my advance, and it's going to be a better year. Okay, so then what you do is you and your accountant prepare quarterly estimated tax payments for 2022 that get paid in April, June, September, and January. And the amounts of those estimates are equal to 110% of your prior year's tax. 110% is the safe harbor amount. So that means so you would pay $11,000 in taxes in quarterly installments totaling $11,000. And you do that every quarter. Hopefully your advance comes in like you thought. Hopefully the other income that you thought was going to come in does. Your accountant calls you, or you call your accountant after Thanksgiving. Hey, I paid all 3 of my estimates. My 4th one's due in January. I think I made even more money than I thought. What should I do? And usually my answer would be pay what we already scheduled you to pay. You're protected and allowed to owe the unlimited amount of money that might still be due on your income in April with your tax return, because you covered the safe harbor provision. So that's an easy way to do estimated taxes. If your income is going to be less than the prior year, then you don't want to pay 110% of the prior year's tax, because that's too much money. You're not going to be able to afford it. It's not going to make any sense. In that situation, you need to look at your income every quarter and estimate what your taxes would be on that income and pay that amount accordingly. So that's the general way of doing estimated quarterly taxes.
Now, we've had a few questions come in about royalties. So one specifically is like, how do you properly enter royalties? For some folks, if they're filing on their own, where does that go? For others, is it a Schedule C and therefore it's not business income? Like, how do we consider royalties when we are filing taxes?
Right. So if we're all here individuals, we're not incorporated, and we're receiving royalties from our literary agent or our publisher, those royalties are probably reported to us on a 1099 miscellaneous in the box that says royalties. On an individual tax return, there's a form called Schedule E, which is for rents and royalties. And that's generally where you put your income from renting a property that you might own, and maybe royalties that you're getting from oil and gas investments. We're not talking about oil and gas today. We're talking about being a self-employed writer. If you're a self-employed writer, your income from royalties belong on Schedule C, which is where somebody who's in their own business would report their income. Even though it's royalties, it goes on Schedule C. The only exception to that rule is if you inherited royalties from somebody, you didn't actually create the work. It's not your self-employed income. You're not actively involved in the business of writing. You're just collecting royalties from something that you inherited. In that case, I would put it on Schedule A, and I would not be taking business deductions against it, and I would be not subjecting it to self-employment tax.
We had a lot of deduction questions come in, so let's buckle up and get started with some of those. Let's start with a threshold question. Is there a minimum amount of income you need to earn that tax year from your writing in order to be eligible to write off expenses related to your writing and your research?
I don't think so. I think that you just have to be careful about having too many years in a row that the expenses exceed the income. But if you're having a year where it wasn't such a great year and you still have the expenses that you normally have to conduct your business as an author with intent to make money, you take the deductions.
Now, is there a minimum amount of deduction expenses that you should have in order to make it quote unquote worth it? And I ask this because we did have one member specifically tell us that their lawyer had informed them that they need to make at least $5,000 or need to have at least $5,000 in write-offs for it to even matter or make a difference on their return. So is that the case, or should we just be looking at always trying to write off what is eligible and legal?
Well, you know, it depends on how you look at things. If you just feel like doing a tax return is the worst thing in the world and you don't want to do anything to make your tax return more complicated or take tax deductions and save money on taxes that you could save, then you maybe take that approach. You know, but if I work with clients that have good years and bad years, and so if I work with an author that's already got this set up, they're already doing their tax returns, they've been doing Schedule C's for years. They know the routine. They made $12,000 this year. That's not so good, but they still have the expenses that they normally have associated with being a for-profit self-employed author. and they've got a system in place that captures that information easily, why wouldn't they give it to me to take advantage of and show the deductions and get the deduction that they're entitled to and pay the correct amount of taxes? There's no minimum income threshold, in my opinion, for doing your taxes in a way that's possible. If it's legally correct and saves you the most amount of money you can on taxes.
Now, speaking of legally correct, there tends to be a lot of anxiety around like, what's a deduction? How far can I push this? Or am I also just not taking advantage of everything that could possibly be a deduction? So a lot of questions actually came in around, is there a comprehensive list somewhere? Is there something I can look up to understand what I can deduct? Now, I'm not even familiar with the IRS having a comprehensive list, and their website, I will tell everyone, is actually pretty great. Like, it's very straightforward, easy to read. It's in nice layman's terms. They have excellent examples. So if there's not a comprehensive list, how do we figure out what we can deduct and what is a little bit of a stretch?
Yeah, I think there's two categories of expenses. There's expenses that are absolutely, without a doubt, not optional and not discretionary. You have to pay commissions to your literary agent. You have to pay legal and professional fees to your lawyer and your accountant. Those are two examples of expenses that are black and white, and you deduct, and there's no question or gray area about that. There's travel, there's entertainment, there's meals, there's promotional expenses, there's research, your internet, your Netflix subscription, your internet connection. These are things that, that are potentially subject to some discretion. And if you're not making a lot of money, I would be a little bit less aggressive on some of the discretionary business expenses. But if you feel like these expenses that are not black and white, like the professional fees and the commissions, if these expenses are legitimately in your head necessary for your business, that they are necessary to promote your business and to make you profitable, you take the deductions. As far as a list of where these expenses should be, the IRS, you're right, Erin, has really good website. It's very user-friendly. And I don't know the name of the publication, but they have a number of publications that are specifically written for self-employed individuals that talk about what's an ordinary and necessary expense and the receipt documentation that you're supposed to keep. Really helpful. And I would recommend that if anybody has questions in this area, that they go on the internet and find it. It's really easy to read. It's written for you, the average tax-paying American.
Now, books can, of course, take years to write and years to publish. And so the question becomes about timing around taking deductions. Do you wait until the publication year to deduct all of the costs related to working on the book? Or do you make those deductions in the year that the event actually happened? So for example, your book is getting published in 2024 and you're doing your tax return for 2023 when you went on a research trip. Am I taking that deduction in 2023 or in 2024 when the published work actually happens?
Okay. So if you are an author that's already reported your income on Schedule C, you've already established that you are a self-employed writer, I would deduct the expenses in the year that you pay the expenses, even if it's for the book that's getting published in 2024. If you've never filed a Schedule C, you've never reported yourself as a self-employed author on a tax return, and this is a new venture for you, I probably would hold on to those expenses, and we use the term capitalize those expenses, accumulate them, and in 2024 on your 2024 tax return, you can deduct all of the expenses that you paid prior to 24 to offset this income that you're receiving in 2024. That's what I would do if you didn't have a record of already filing as a self-employed author.
Now, what about professional memberships like the Authors Guild? Are those deductible?
Yes.
Easy peasy. Now, what are some, oh, sorry, we already actually did tracking expenses, but there have been a lot of questions around asking, meals, gas, travel. It sort of feels like those change somewhat frequently. So what is your recommendation on keeping tabs on those types of expenses, particularly for travel, and also making sure that you are appropriately taking the deduction?
So travel is a great area. So let's say you go to a writer's conference and you take a plane there and you bring your spouse. and you stay there for 3 nights in a hotel. What I would say is that you should deduct 100% of your airfare, probably not your spouse's airfare, unless they are absolutely, essential to your schedule and your business as a writer. I would say it's a little aggressive to take that position. So you take the deduction for the airfare for yourself. And as far as the hotel is concerned, look, it costs the same amount of money for the room, whether it's got, it's got 1 bed, assuming you share the bed. And so, there's no extra charge for 2 pillows. So I think you would take the deduction for the entire hotel. And then as far as the meals are concerned, while you're there, the correct thing would be to figure out the meals and take maybe a percentage of them, because it's 2 people eating. So you take a practical approach. Look, this is an honor system. The IRS audits less than 2% of tax returns every year. And they're saying that that's going to increase, but we're supposed to do this in an honorable way, in a way that makes sense. And that's my general approach, to just be sensible about this and don't be overly aggressive, because there are things with, there are red flags, and travel, when somebody's unlucky enough to get audited, the areas that the IRS look at are meals, entertainment, travel, and automobile expenses. That's what they look at.
Oh, excellent to know. Hopefully, knock on wood, it doesn't happen to any of us. Now, as speaking of keeping track, is it okay to keep receipts in an e-file, taking a picture, uploading them somewhere to keep track, or do we need the hard copy?
Absolutely fine to do everything digitally at this day and age.
Excellent. Let's pivot a little bit to talking about S Corp. As a reminder, we do have the webinar that exclusively does focus on LLC versus S Corp, what might be most appropriate for you, figuring all of that out. But of course, we naturally did have quite a few questions on both entities. When is it appropriate to form an S Corp to protect your writing income? And in addition, what happens if your income ends up changing significantly, maybe decreases or stops altogether in the subsequent years after you file an S Corp?
Okay, so to be an S corporation is basically you're incorporating. You incorporate yourself, and then you elect for the corporation to be called an S corporation. And what that means is the corporation is a separate entity that files a tax return and reports your income and expenses as a writer, but the corporation does not pay taxes. It just reports the information, and the flow through, the net income of this S corporation gets reported on your personal tax return. There's tax advantages to doing that, depending on what your income is, and I'll talk about that a little bit in a second. But none of this protects you personally from a legal or liability perspective, and I'm not a lawyer, so you can ask your lawyer that one if you want. But the reason that people form an S corporation is because the net income from an S corporation, while subject to regular income taxes, is not subject to self-employment tax. So in the beginning, I told you all that the first $147,000 of self-employment income is subject to Social Security tax. When you're self-employed, that's Social Security times 2, the employer and the employee side of it. So if you make $500,000 as a self-employed writer, you're going to pay Social Security tax on the $147,000, plus you're going to pay the Medicare tax that goes on top of that on the full $500,000. If you're an S corporation, the S corporation net income is not subject to the self-employment tax, not subject to Social Security, not subject to Medicare tax. Well, you can't get away with paying none of that tax. You have to pay some kind of a salary for yourself. So you pay yourself a $100,000 salary, you pay Social Security on $100,000 and Medicare on $100,000, but the other $400 is not subject to the Social Security and Medicare tax. So you save yourself some money. So there's a good tax savings. And the more you make, the better it gets. If you find yourself that you did do an S corporation, it made sense for the reasons I described, and then your career takes a change and you're not making the same money you used to make, at some point you decide that it's not worth the professional fees and expense and administration to continue to maintain the S corporation. If that's what you think, if that's what you decide, then you just file a final tax return and dissolve the entity.
All right, excellent. Now, this is a bit of a niche question, but I know we have some folks tuning in who either work as ghostwriters or perhaps work under a pseudonym, obviously 2 separate things. But are there any special either instructions or considerations that those types of folks should be thinking about when it comes to filing taxes?
I don't think so. I think we'll take them one at a time. If you're a ghostwriter, you're performing services, you're doing work for hire, and you're self-employed, and you're gonna get a 1099 probably from somebody, and you're gonna report that income on Schedule C the way any author would, and you're gonna deduct the expenses associated with your work as a writer. And I think it's the same as if you were the author that's on the front of the book. If you're operating under a pseudonym, I think it doesn't. I think you're still ultimately who you really are, and you have your Social Security number, and so the government's going to be expecting you to report that income on your tax return. I don't know if the literary agent would ever. I assume the literary agent is going to issue a 1099 in your actual name with your Social Security number on it. So just hopefully that is kept confidential. But I think it's the same way as if you were operating under your actual born name.
A lot of folks have questions around how to find an accountant. Do we need someone who specializes in working with writers, freelancers, self-employed folks? And what's a good way to vet and find someone?
Yeah, I think most of my clients come from either successful authors that are happy with what I do and they tell their friends, or they come from their literary agent, or sometimes they come even from the Authors Guild. It's really talk to people that are in a similar business as you, talk to your friends, talk to your peers, and ask them if they like their accountant or not. I think that's the best way to get a new accountant. Looking in the yellow pages or Googling people is certainly a way to do it too. I do get phone calls from people who said, I found your name in Google. And, if you call me, you're lucky, but you might call somebody else and maybe not have a good experience. So I would definitely talk to your friends, your peers, and get their recommendations.
I second that. And also make sure it's somebody with whom you feel comfortable and can ask questions and you understand how they're explaining things to you as well. I think that's really important. You can shop around.
It's really about chemistry. That's right. I mean, hopefully any accountant that you talk to who's a CPA, and you really want to work with a CPA, any CPA is going to know their business about taxes and self-employment and everything else that goes on with your work as an author. It's nice to work with someone who specializes in publishing, but ultimately you have to be able to talk to them and trust them and be comfortable with them. So if you have that chemistry, great. If you don't, it's not worth it to get into that kind of relationship without it.
Now, what about for folks who maybe have fellowships, win awards, and receive compensation that way? What are some things they should be considering in terms of paying taxes or unexpected things that might come down the pike for them during tax season?
Well, that's a special situation, and sometimes those awards can have special rules for whether they're taxable or not taxable, whether they're subject to self-employment tax or not. So I think it's on a case-by-case basis. In that case, you should really talk to your accountant about it while it happens, while it's happening, so that you can get the right answer before tax season and not be surprised or caught short.
Now, I do want to spend a little bit of time talking about retirement and more just very high level. We mentioned earlier the SEP IRA, that's SEP. I know that was a question. Self-employed pension, is that correct?
I think that's what I think it stands for sometimes, but I think the actual definition of the acronym is Simplified Employer Pension.
And you are both the employer and the employee a lot of times in the case of the SEP. Now, obviously, we also have a traditional IRA, a Roth IRA. And for those of a certain age, which I believe we're talking 59 and a half, they can make catch-up contributions to the traditional and the Roth IRA.
Very close, Erin. 50. If you're over 50 and a half.
50 and a half.
I think
What's
it's
with
50.
the halves? I don't
know about the half. They like
half.
the half. I don't know, but I don't. What do you do in a leap year? But anyway, if you're over 50 or 50 and a half, you're able to do something called a catch-up provision, which basically is an extra $1,000 for the IRA and an extra some other number for there's extra money you can put in. But the 59 and a half threshold is when you're allowed to take distributions without paying the 10% penalty on top of the regular tax. But anyway, what's the question?
So the question is, when we're looking at taxes, I think sometimes it becomes a bit easy for self-employed folks to neglect needing to set themselves up for retirement, but tax season is an excellent time to take advantage of making sure you invest for retirement because you can lower your taxable liability. So what are just some of the things that people should look into? How do you decide if we're going Roth or traditional or SEP? The thresholds are so different.
Yeah, I was reading this in this weekend's paper, the significance of saving for retirement in general, but specifically doing it earlier than most people do it. Most people will decide to put money into an IRA when they file their tax returns on April 15th. So you can do that. You can April 15th get a tax deduction on your 2022 tax return if you put $6,000 or whatever the number is in your IRA before April 15th, 2023. But you know what? You're allowed to put the money in at the beginning of 2022. You didn't have to wait 15 months to put the money in. If you know you're going to be eligible for the IRA, tax deductible IRA, and you want to do it, you can do it at the beginning of the tax year rather than after the year's over with your filing. And doing that has the money working for you longer. And the effect of doing that over a lifetime is pretty substantial, depending on your returns on your investment. So that's just one thought on it. Saving for retirement is really important, as we all know, and sometimes really hard to do because we have this priority about, living in the moment, living today. But so what people usually do is they start off with things like an IRA because it's something that is easy to do, not complicated, and it's a good basic discipline. It's a good way to start out. And hopefully as you do better and you start to get a nice advance or a nice book contract as you become more established, at that point, you're going to hopefully make more money than you need to live on every day. And maybe take a nice vacation or something to reward yourself. But it becomes a discipline that you're going to put away money for the future that you're not going to need until you're over 59 and a half. And when you do that, when you're at that point, that's when you're going to think about doing a SEP. And it's a great way to save money. My computer went to sleep. Excuse me 1 second. I'm back. Okay. So yeah, I think a SEP is really a good next step for an author once they've gotten over a certain threshold. And that threshold is when you have enough income to pay your taxes and your lifestyle and be able to put money away. You're taking money from your right pocket, putting it in your left pocket and getting a nice tax deduction for it. It's a no-brainer in certain situations.
Now, this was my fault for how I phrased the SEP, but we had a question come in, a fact check of, I don't think you have to be your employer and your own employee. This person works as a consultant, and I think you can still open a SEP, but please confirm. So I just wanted to say I am both my own employer and an employee and have a SEP IRA, but that doesn't have to be true of everyone's SEP experience.
Yeah, I mean, I think when you're self-employed, you are both. It's more of an expression. But if you're a consultant or an author and you're self-employed and you're not a participant in another retirement plan, and you make enough money to be able to think about putting money away for the future retirement, I think a SEP is an excellent opportunity to save money on taxes and save for the future.
Now, another question specific to retirement accounts is evidently, and congratulations to this person, they have phased out of being able to contribute to their Roth IRA because their income has exceeded the contribution limits. I don't know that we need to get into the conversation about a backdoor Roth IRA right now, but the question is, are there similar limits for a SEP? So do you have these similar income restrictions?
No, as long as basically the maximum amount that we can put into a defined contribution plan, which is a SEP is one of the defined contribution plans that exist in this universe of pension plans. The maximum amount we can put into a defined contribution plan is $61,000. And as long as you qualify for that amount, and basically that is roughly 20% of your self-employed income. And so you do the math, I think it's like $250,000, whatever the number is, you are eligible to put up to $61,000. And you can make $1 million and still be eligible to put the $61,000 in. There's no cap the way there's no limit or exclusion like there is for contributions to Roth IRAs.
But there is a lesser contribution. I think it's 25%, the lesser of 25% up or 61.
It's 25%. It's 20% of your self-employment income, maximum of $61,000. And then if you have employees, I'll give you a quick example. This is maybe a little bit advanced, but we'll do it. We'll give it a shot. So I have an author whose spouse works for her. He does not have a day job. His job is to keep her calendar and buy her paper and keep her calendar and do all that kind of stuff. So she makes a lot of money, and we wanted to take advantage of some tax rules that I don't want to get into, but we decided to put her husband on the books as an employee. So now her self-employed business is paying money into her SEP, 20% of her profit, and also in the SEP for her employee, 25% of his salary. It's 25% on salary, 20% on profit. So we're getting SEPs now for both of them. And the purpose of me bringing this example up was just to say that it's 20% of self-employment income, 25% of wages.
Excellent. Now, pivoting a bit away from retirement accounts, and feel free to keep sending those questions, but I want to make sure we diversify our conversation a bit. We had someone come in asking a question about an EIN versus your social security number for a sole proprietor. What do we need to think about in terms of when should we have an EIN or social security number the right thing to be using for filing?
Well, you don't really need an EIN unless you have an employee. If you have an actual employee, you need an EIN in order to process payroll. If you don't have an employee, the only reason that people would have an EIN is because they think they're supposed to and they just do it. Or they feel like they don't want their social security number out there with everybody knowing about it, whoever their publisher is or anybody that they do business with. I don't think that's really a great reason. And sometimes when you do submit your information on what's called a W-9 to whoever's paying you, I think that sometimes the rules for self-employed people is if you have an EIN and you have a social security number, they actually want your social security number according to the form. So you can give them the EIN and probably they won't even know that it's wrong, but technically it's supposed to be a social security number. So the fast answer is you don't need an EIN unless you have employees that you're paying wages to.
Well, speaking of having employees, do you have to send 1099s to people that you pay over $600? What's the threshold? And maybe they're, an ongoing getting a paycheck from your employee. Maybe it was a one-off consultant that you hired to spruce up your social media or create a website for you.
Yeah, I mean, the rule is that if you're in a business and you pay an entity that's unincorporated, that's generally human beings or LLCs or LLPs, if you pay an entity that's unincorporated for services that they rendered to you, and the amount that you paid them during the year was in excess of a total of $600, you're required to report that information to them on a 1099 NEC, non-employee compensation form. And you're required to do that before January 31st and file a copy with the IRS. There's questions on the Schedule C, yes or no questions. Were you subject to this rule? Yes or no? Did you do it? Yes or no? They're right there on the form, and you're supposed to do this. If you don't, technically there's a $50 fine for every form that you didn't file. I've never seen someone get that penalty assessed, but you're supposed to do it, and we help our clients with that when it's applicable. Another question that might come up is, do I have to give my literary agent a 1099 for the commissions that I paid them? We don't do that.
What about for those who are listening in right now and either are aging into retirement or have already retired? Are there special considerations they need to be thinking about when filing taxes?
Well, I mean, there is this rule called the required minimum distributions. If you have retirement accounts, IRAs, SEPs, and the rules that the ages are changing, but I think it's right now it's 72. If you're turning 72 in this particular year, you're required to make a distribution of whatever your life expectancy is. There's tables on this stuff, but it's roughly 1/20th of whatever's in your account, and you're required to do that annually. And whoever has your money should be the person who alerts you to that, and make sure that that distribution gets done. That's one thing to think about. The other thing to think about is that you have to understand that this money is taxable. So when you're taking the distributions from these retirement accounts, they usually give you options on how much tax to take out or not take out. And if, one of the options, let's say, is take 10% federal tax, understand that you didn't fully pay your taxes. You probably only paid part of your taxes. Another thing to understand is that certain states exempt some of your retirement proceeds from taxes. So you need to know about that also. I think, for example, New York State excludes the first $20,000 of distributions from retirement plans from your taxable income on your New York tax return. So that's a couple of thoughts for retirement.
Are there age restrictions for setting up a retirement account? If you are 67, can you still set up a Roth IRA?
I think you can. Yeah.
Now, what if you, to kind of tie all the way back to our very first question, what if you do consider your writing a hobby and you're not maybe necessarily even looking to make it a business, but earned a little bit of a modest income on it? Considerations for paying taxes?
Well, if it's a hobby, you're that's a tough one. That's a great question. If you're just doing this for fun and by sheer luck, or maybe just because you deserve it, you got paid a lot of money for this hobby that you had, I think you're obligated to report it as income. And so since you're obligated to report it as income, I would look at the expenses that were really directly associated with this profitable hobby, and I would deduct them on your tax return.
We do want a repeat of the red flags for the IRS and an audit. So entertainment, travel, meals,
Automobile.
That's the fourth. A few questions coming in as well about the previously mentioned concept of waiting until, if you're not yet an established writer, you don't have published works, you're working on a book, waiting until that book is published to start taking deductions. But what happens if it takes you 7, 10, 15 years to write the book? Are you still eligible to be taking a deduction so far down the line?
I don't know. That's a really unique circumstance. I would think that there's going to be some limit to how far back you can go. But whoever has that question wants to talk to me, just contact me directly. We can talk about it some more.
Now, for authors who sell their book at a live event and sales tax, what are things that we should be considering in terms of having to pay sales tax when, let's say you live in New York, you go to Texas for a book fair, you are selling the books directly yourself, you don't have your publisher there selling them for you. What do we need to know?
Well, I think ultimately you're going to do nothing, but technically you're selling something, you're selling tangible personal property, and in most states subject that to sales tax. I don't think that they're going to worry about you selling $100 or $200 worth of books. The tax on that is a few dollars, right? The sales taxes are roughly somewhere between 8 and 10% in most states. So, you owe the government $20, $30. I probably wouldn't worry about it. If this is becoming more of an activity than just a general once in a while trip to a book fair, then maybe you need to start registering with the state and paying the taxes. Maybe the event does it for you. Maybe there's some forms that you can do with the event. And ultimately, on our personal tax returns, most states have a line that allows you to volunteer taxes that are related to sales or use taxes. Maybe that's a place to do it. The only thing I would just say is, no good deed goes unpunished. And, for such a little thing, you try to be super honest and disclose this information, and it opens a door to a bunch of questions that you don't want to answer. So, we all want to do the right thing, but if we're talking about de minimis money, I think you just forget about it.
Well, a couple of questions as well about 1099 NECs. So if somebody hires, let's say, an editor for their manuscript or writing coaches, are those deducted under professional expenses on a Schedule C, or are they having to file a separate form for that person's services?
So you deduct it on your Schedule C as whatever you want to call it, professional fees, or you can be specific, editor or whatever. You deduct it on your Schedule C as a business expense. and you are required to report what you paid to them on a 1099 NEC if you paid them an amount in excess of $600.
Let's talk a little bit about separating your personal expenses and spending and your business ones. So if, let's say, you're somebody who has a day job, but you also make writing money on the side, it's best practice to have your paycheck from your day job put into your personal checking account and to set up an entirely separate checking account for your business income that is from writing.
I would say it's a best practice. Yes, it might be depending on how little your side writing is. I think if it's significant enough, it's a great idea to have a separate bank account and a separate credit card to segregate your professional income and expenses from your regular wages and personal life.
And to be clear, that doesn't technically have to be a business account in the sense of like you go to the bank and set up a business checking account. It can just be like, I have this bank account and this bank account. And
That's right.
Okay.
Yep.
And same with the credit cards as well. Now, you might move into a phase where you want the business version, but you could just have a plain old credit union banking account version.
Right. And to expand on that, let's say that, we were talking about reserving money for taxes before. If you have two bank accounts, one for business, one for personal, when you receive that $100,000 advance into your business account, and you want some of that money to enjoy life with, fine. You take 60% of it from your business account to your personal account. You left 40% in the business account. That 40% is there for you to pay your taxes when they're due. So it's a great way to budget for taxes as well.
Home offices. People want to know what can be considered a home office. What if it's a mixed use room? I'm going to be honest with everyone on here. I'm a New York City resident. My home office is half of my bedroom. There's like a nice bookshelf up, but it is in technically what is my bedroom where I sleep at night. So what can be deducted? What about utilities and those expenses? What are we considering?
Okay. So I'm going to answer that question two ways. First, I'm going to talk to people who do not live in an apartment in Brooklyn. So let's say you live in a typical suburban home. It's got 3 bedrooms. The rules are written for you, and they're really talking directly to you, if that's who you are. It says that you must use the room exclusively for business in order to take the home office deduction. So then technically, if you're using one of those bedrooms as your home office and you're not using it for anything else, the kids aren't doing their homework in there, you're not sleeping in there, it's your office, that's what it's for exclusively, then in the strict interpretation of the rule, that's going to be eligible for the home office deduction. And you take the square footage of that room compared to the square footage of your home, and that's your percentage of office use. And then you take that percentage and apply it to things like your mortgage interest, your real estate taxes, your utilities. I think those are the main things that I would apply it to. Things like internet, I would not consider that home office. I would consider that a direct expense because your internet is for you to be connected to the internet to get information and media and things that you need to be in your own business. Sure, the kids might use it to watch SpongeBob, but that's just how it is. There's no reason, in my opinion, to allocate. I take 100% of that and I put that on a business on the Schedule C, not on the home office deduction. So interest, real estate taxes, and utilities. And if you're renting that house instead of owning it, rent goes there. So that's my explanation for home office deductions. If you live in an urban area like Brooklyn, the exclusively used for business clause to me is just inappropriate, and I don't apply it in a literal perspective. You have a 1-bedroom apartment and you use part of the space to work, and you also use that space to sleep and do other things. That's how it is. And so that's how we do it. And we don't worry about the exclusive purpose. But if you're in the suburbs and you have a house with lots of room, I think you got to be a little bit more respectful of that rule.
Now, we'd mentioned earlier about the fact that if you create an S Corp and then life changes, you can simply dissolve it in the future. That's always an option for you. What about if you're somebody who has been filing a Schedule C, you've been looking at your writing as a business, but now it looks like it's morphing more into a hobby? Do you just simply stop filing the Schedule C, or is there something more formal that you need to do?
Nothing more formal. You just, if if all of a sudden you just don't have any income to report on Schedule C, or you have a small amount of income that you would pick up on your return on just a miscellaneous income line and not file Schedule C, so be it. There's no declarations to make, no dissolutions to make. You're a sole proprietor and the form's not applicable anymore.
We are coming close to time. Quarterly estimated tax question though. What if you should be paying quarterly estimated taxes throughout the year and you don't, you just pay the total due at the end of the year? What might happen?
Well, what you should do in that case, if you're using good software, let's say you're doing your tax return yourself using something like TurboTax, it should be set up to self-assess what's called the underpayment of estimated taxes penalty. And it's roughly 10% of whatever the underpaid tax was. So if your tax last year, two years ago, was $10,000 and you didn't pay any estimates, and so now you owe $10,000 again, let's just say, you underpaid your estimated taxes by $10,000. And the penalty for that would be roughly 10% annual interest rate on that $10,000. Now, it's not 10% of $10,000 because you made part of that 10 in the first quarter, part of it in the second quarter, and so on and so forth. So it's roughly half of 10% when you do the average. But yeah, it's going to cost you about $500 in underpayment estimated fees, and that should be calculated by the software on the return when you file it. If you don't do that, the IRS will send you a letter thanking you for your tax return and the $10,000 that you hopefully paid with the return, and let you know that you have underpayment penalties of $500 and that you owe them the money. That's how it works.
Now, again, kind of tying back to a deduction question, there's a few folks who have written in about feeling a sense of concern that, let's say their expenses for a book that was published last year was $8,000 and their earnings was only $1,000. Should they be adjusting down their expenses? Is it going to be seen as a red flag if they have spent more on expenses than they have thus far earned on the book?
I think if the expenses are legitimate and they're necessary for the business, I wouldn't underreport my expenses if they met that criteria.
I have a little smile because somebody wants to know what you're holding in your hand and where they can get one. They said there's a little pink thing that they see Robert holding.
Oh, wow. I didn't realize that was visible. I didn't realize it's so visible. Okay. It's a Sharpie.
There you go. Staples, Home Depot, wherever you can get one yourself.
Absolutely.
I have a croissant shaped stress ball that I think I should have out here for these things.
Mm-hmm.
Health insurance, any big considerations we should keep in mind when filing our taxes?
Yeah, self-employed people are allowed to deduct their health insurance. It gets deducted on a separate line of your tax return, and it's deductible if you have a profit from your self-employment income. If you don't have a profit, it's not deductible. It becomes deductible possibly as a medical expense on your itemized deductions, Schedule A. Most of the time it's not deductible because if it's in that area, it has to exceed 7.5% of your gross income. And hopefully that's not the case. But that's where it goes. If you're profitable, if your health insurance is $20,000 a year and your profit is $25,000, you can deduct that full $20,000 on the special line for self-employed health insurance.
What about donations? If you are an author who donated a significant amount or even all of your earnings from a book to charitable organizations, do you have to be reporting that on your taxes? How does that work?
Well, you want to. The deduction for contributions to charity goes on Schedule A, and you're allowed to deduct up to 50% of your income for charity if that's how much you gave away. And so it's a good idea. Another thing that I didn't mention in my little beginning of the update, there's something called the qualified business income deduction, which is pretty popular. It was put into law in 2017. It was a way to kind of level the playing field when they decided to cut the corporate tax rate for big corporations. We're allowed as self-employed individuals to deduct 20% of our net income from writing on our tax return for this line called qualified business deduction. It's phased out if you make over a certain amount of money, but for people who are making within that threshold, it's a great way to get a tax deduction. So if you made $100,000 from writing and that's all your income for the year, and you don't have any income from any other sources, you're going to pay federal taxes on 80,000, not 100. So it's just an extra deduction you get by law.
Been asked a couple of times for just a quick repeat on what happens if you are living in an urban apartment where maybe your bedroom and your office are a mixed use space.
What happens?
They just want reassurance that you still can take a home office deduction, even though technically it's not solely used for your office.
I live in Manhattan. I have clients that are self-employed writers in all the boroughs of New York. We do the tax returns the way I described it. I've never seen anybody get in trouble for it. We all live in the same place. If the IRS audits that particular person, yeah, they're going to look at the car. They're going to look at the car really hard. What do you need a car for? You live in Manhattan and you're an author. That one they're going to go over. They're going to get you on that one. But they're not going to even talk to you about the home office deduction because they understand we all live in the same kind of environment.
Do you happen to know if the Author Guild offers any sort of go-to directory for accountants?
I don't know. It's a good question.
And also that might be able to be included in a follow-up email, the answer to that question. But in addition, I just want to reiterate the former advice in this to ask fellow colleagues or friends who work in this environment to ask for recommendations about finding a CPA and make sure you shop around a little bit and find somebody with whom you're comfortable. You can ask questions. You feel like you understand what they're actually saying to you. You know, it's really important, particularly when it comes to your money, that you want to feel in control and actually understand what is going on. And you are certainly smart enough to understand what is going on. I think a lot of times people get into this mentality where it's like, oh, this is just sort of like not how my brain works. Your brain can absolutely work this way, I promise you. Well, is there anything else that you want to add in these final couple of minutes that we have together? Any other big considerations, any last bits of piece of advice other than get your taxes done? We're coming up against a deadline in just several weeks.
That's what I was going to say. Get your taxes done. Don't wait.
Absolutely. Well, thank you so much. For everyone else, this has been recorded. You can certainly go back and watch. I know it is so much information to take in all at once. As a reminder, we do have a former webinar that talks about LLC versus S Corp. And we also have last year's edition of this webinar, which focused on myriad of questions, not all of which we covered today. So feel free to also go back and watch that. Thank you all so much again for tuning in. And Rich, if you have anything else you want to pop up and say.
All right, thank you both so much. Yeah, everyone who registered, look out for an email in the next day or two that'll have a link to the recording and any other things that we want to include, like that old webinar about S Corps and stuff. So yeah, thanks everyone for attending and look forward to seeing you at our next webinar. Have a good day, everyone.
Thank you. Bye.